Good afternoon, Southern California. I'm John Baldwin with John Hart Real Estate, and today is Tuesday, August 30th. Tried to get a video out to you yesterday, but I was having some technical difficulties syncing the audio and the video. My lips were just completely out of sync with the audio, so it's improved. I think I still need to dial it in a little bit more, but we'll push through and get this video out, and then I'll keep working on it. A lot of data is coming out this week. We had Jerome Powell, the Fed chairman, on Friday, basically saying he's going to continue being aggressive. The Fed is going to continue being aggressive on inflation. So what does this mean? Well, the Fed is meeting this first week of September, so we're probably getting another 75 basis point rate hike on the Fed funds rate. What does this mean for mortgages? Well, I think the mortgages are already factoring in the higher cost of money because remember, when you originate a mortgage, you're usually 30 days out or 60 days out from when you close that deal. So if rates are going to be more expensive in the future, and it's going to be more expensive in the future, lenders typically build in what they think is going to happen at the Fed meeting. So they build in, and rates are already popping into like the 5.3, 5.4 range. I haven't checked today, but that's where they were yesterday for the high balance mortgages, which is pretty much every mortgage in California. So this is definitely something to be aware of. And then we got more data coming out this week. We get Chinese data, the Chinese market index, I think it's called PMI, and then the Eurozone consumer price index numbers, and then we're gonna get the U.S. non-farm payroll report on Friday. So there's a lot of data coming out this week, and then also it's the end of the month. So on Thursday, September 1st, I'm gonna have all the August data, and we can really dig into the MLS data and show you what's going on, because I've got a little bit of a mixed bag for you today. We got the S&P Schiller index. Then there was an article last week about a 0.77% price drop. And so I think we need to look at all these factors and kind of look at the overall, like there's a difference between the monthly changes, like monthly up and down, versus the annual. And I like to talk about the annual, but the monthly is also important. So let's get into the article here. So this is CNBC.com from today, which I was basically looking at like 2 or 3 articles yesterday to get this same data. So I think this, oddly enough, the technical difficulties I was having helped pull all the data into one article. And then there's another thing I want to jump into from Housing Wire. So home prices in June were 18% higher than during the same month last year, according to S&P CoreLogic Case-Shiller indices. Now, CoreLogic is actually the company that provides our tax roll data. So they are like plugged in to all the tax assessors' offices, all the actual transfers. They've got all that data. So that's why I'm a data nerd. I like it. I think this tells us what, the better data we have, the more data we have, the better decisions we make. So, all right, that's a weaker pace than May of this year, which had a 19.9% annual gain. Another report last week showed home prices fell 0.77% from June to July, the first monthly decline in nearly 3 years. Now remember, we frequently will have a little frothiness, like 1 month will be up, 1 month down, 1 month up, but you have to look at the longer trend lines. But we want to make sure that we're staying out ahead in case we start stacking up multiple months of losses in a row. Then we know we got some bigger things moving around. So 18% higher, we already said that. Of the 20 cities, Tampa, Florida, Miami, and Dallas saw the highest year-over-year pace in June, with increases of 35, 33, and 28.2% respectively. Those are huge jumps. Huge jumps. It's important to bear in mind that the deceleration and decline are two entirely different things, and that prices are still rising at a robust clip, wrote Craig Lazzara, managing director at S&P Dow Jones Indices. And this is what I'm trying to talk about. Like, you have to look at the long-term trend versus the month-to-month changes. It's like for day traders, if you're watching like the minute by minute versus like the week by week, or maybe that's not the right, maybe for stock traders versus day traders. Stock traders, if you're buying and holding, you don't want to look at that day-to-day frothiness of the up and down. You need to look at the longer term. So I think this is what they're talking about, is looking at don't get caught up in the monthly data. Look at the longer term data, because overall the trend is upward right now. But we don't want to completely discount the fact that there is some adjustment in pricing. And what I like to call in this type of market, this is in a weird way, we encountered this in like 2009, 2010, where prices started separating out again. It used to be every house, no matter what, was selling for top dollar over the last couple years. Could be a fixer, could be whatever, because people were just like, I need to buy it and then I'll add money on top to fix it up to the way I like it. Right now, the separation is happening. So the perfect houses are selling for top dollar, even going over asking. Still, the houses that need a lot of work are starting to separate out, and the prices are starting to separate out. So this is good for everybody, but especially good for buyers right now, in that you're not paying for a property that isn't in perfect condition top dollar. So I guess you're not paying top dollar for a property that's not in perfect condition is a better way to put that. So, all right. June's growth rates for all three composites are at or above the 95th percentile of historic experiences for the first 6 months of 2022. In fact, the national composite is up 10.6. So, I mean, again, I've been calling a return to normalcy like 3 to 7% annual appreciation. So we're still above that right now. But I think we're gonna basically return to it. It's just taking a while to get out to that. So we're gonna taper, and then I think we're gonna get to that 3 to 7% annual appreciation. And then here, another report last week showed home prices declined 0.77% from June to July. So let's take an $800,000 house that decreased like about $7,000 ish. So, I mean, that's not a huge drop, but it is a drop. It's one of the biggest decreases we've had in years. And, that's one of the things you just want to make sure that you're looking at all the data and take a kind of holistic approach to it. So, while the drop may seem small, it is the largest single month decline in prices since January 2011. It is also the second worst July performance dating back to 1991, behind the 0.9% decline of July 2010 during the Great Recession. Now, home prices are softening due to rising mortgage rates, which is what I was about to say. I think what we saw here is such a drastic increase in mortgage rates that it kind of shocked the system, and we had a nice pullback. We had a lot of cancellations, especially people who are in those upper price ranges, when all of a sudden your interest rate went from 3.5% to 4.5%, 5%, 5.5%, or 6%, you saw your payment potentially go up by 40 or 50%, depending on when you were first started looking to when you got under contract. So all of a sudden the math changed dramatically. And I think we just need to make sure we're all staying ahead of the data. But I'm kind of excited for this week, because we're going to get all the August data, which will tell us if this was a blip or if this is the continuing trend. And that's what we want to make sure we are, again, I keep saying it, we're out in front of, because there's this graphic down at the bottom of the page here. Los Angeles, 4.3% decline, San Jose, 10%, San Francisco, 7.4%, Seattle, 7.7, Denver 4.2, and San Diego 5.6. These I'm not seeing major price declines. So I'm wondering if this is a function of what was selling, or if it's a monthly blip base, because when you look at what was closing in this, I believe this is July. So all those went under contract either late May or early June in order to close in July. And so we may have had that big spike in interest rates, and then it came back down, and we just need to look at the data, because again, and I'll keep emphasizing, the overall trend is up, the month-to-month data is down. So this is where we have the mixture of data I mentioned. So Now I want to jump over to this HousingWire.com article. And this is does Jerome Powell's tough talk mean another 75 basis point rate hike? But I think the important thing I want to see here, and then I get into it, is Housing Wire lead analyst Logan, and I'm going to mangle your name, dude, I'm sorry, Matashimi, said that while housing isn't the main focus of the Fed's action, it wants to fight back against the housing market's perception that the Fed will cut rates next year as the market gets weaker. I think the Federal Reserve is frustrated that total housing inventory is not back to 2019 levels, even though mortgage rates have gone as high as 6%. They are frustrated, and the fact that new home listings are now declining can't be encouraging to them. Powell's comments reaffirm their stance that they will hike rates and keep them high while looking to see what happens next. Because, and this is the reasoning, they're looking for price stability and they're trying to combat inflation, which is just going through the roof right now. And if their target is 2% inflation, and we're probably in the like over 9% inflation right now, they've got a lot of work to do, and I think they have to be at least vocally aggressive. But this is the stuff I've been talking about, where we got to make sure that we look at all the data, look at it holistically, not freak out because of a 1 month dip. We have to look at longer trend lines. And but the data, I mean, we're still up year over year. I've seen August, somebody estimated August data was going to say we're up like 10.8 over August 2021. But we'll find out more. Tomorrow's the end of the month. So Thursday, September 1st, we're getting all the August data from the MLS systems. And I'm going to be able to update my months of inventory chart. And I've got some data I'm going to show you when you look at like the 1 month versus like the 3 month rolling average. And this is why I like the 3 month rolling average, because it takes out a little bit of the frothiness of it and gets you that bigger trend line. And but we'll keep an eye on everything, because there's going to be a lot of data this week, and we're going to see what's going to happen. And I'll keep you posted. But let me know if you have any questions. Give me a call, 213-973-3777, and let's get your house sold.